Hello, everyone, and welcome back to the Female Property Expert Podcast. I'm Emma Morby, and in today's episode, we're diving into one of the most crucial skills in property investing, which is how to assess a property deal itself. Now, knowing how to properly evaluate a property deal can be the difference between a profitable investment and a pretty big, costly mistake. This is more than just finding a property in a good location. It's about analysing the numbers, spotting the potential red flags and ensuring that each deal aligns with you or your overall investment goal. So in short, basically, it's a skill that can make, or I think break you from a success standpoint as an investor. So today I'm going to walk you through the step-by-step process for assessing property deals. Now, I'm going to break it down with the exact steps I use. I'm going to share examples from like the UK market and give you practical tips to boost the confidence so that when you're evaluating your next potential investment, you feel like you understand what you're meant to be looking for. Hopefully, by the end of this episode, you'll know how to approach deals strategically and how to avoid common mistakes. And if you're ready to get yourself investing, then hopefully this will be a little bit more knowledge that will secure yourself and also any deal that you find long term. So let's get started. So before you can assess any property deal, it's essential to be clear on your investment goals. So many people don't do this part. Are you looking for a property that will bring you in a steady monthly income? Or is your goal long term and the idea is the capital appreciation in the property will increase? What's your objectives? Because your objectives will determine the type of property you look for and how you evaluate it for its potential. So as an example, when I left my ex-husband, I wanted to basically start again and be in a position not to have a mortgage and buy a small holding down in Devon. That meant that I had to pick a certain type of property development deal to be able to give me the finances to be in a position to do that, should I still want to in a few years' time. And that's kind of how I started. I worked out what I needed, and then I worked backwards from that to create how I would get there. So let's start with cash flow versus capital appreciation. If your goal is cash flow, you'll likely focus on rental income and properties with sort of high yield potential, often in areas with affordable housing or really high rental demand. So, for example, there are some parts in the north of England, like Liverpool and Manchester, where yields can be much higher than even in London, believe it or not. London isn't actually a great place for yields, rental yields. On the other hand, if you're looking for capital growth, you might prioritise areas with rising property values. So parts of London, ironically, or any kind of key commuter town are going to be good places to start looking. You also need to be aware of risk tolerance. So think about how much risk you're willing to take on. Higher yielding properties may come with greater risk. So this will be things such as fluctuating tenant demand, while safer investments might yield low returns. It may not get you there as quickly as you want. So knowing your tolerance can help you focus on the right properties. Are you willing to wait 5 years or 7 years or 10 years, but take less of a risk? Those are the questions you need to ask yourself. And I call it time horizon. So are you looking to invest for 5 years? Are you looking for 10 years? Are you looking for 20 years? Are you looking for longer? Your time horizon will affect you and how you evaluate your deals, like the return on investment part of your deals. And it'll help you decide if a property fits within your plan. If your plan is to get in, buy property, do it up, flip property for the next 10 years to make £1 million, because that's what your goal is, then you understand what you need to have for your return on investment for everything that you put in. What do you want out? As in, what's it going to give you in your ROI? Whereas if you're 22 and you're starting this journey and you think, well, I want something for the next 10 years the next 30 years, 40 years, 50 years. And actually, I'm quite happy to build it slowly, but I want cash flow. I want to be able to enjoy my life. I want to earn 10 grand a month, 20 grand a month, that sort of thing. Totally different way of looking at it. Your time horizon is really important. So work out how long you're looking to invest. Now, do me a favor, take a moment to clarify these goals, because it gives you a framework to assess deals consistently and ensure that they align with what you're trying to achieve, and try not to stray from them if you can. I often recommend sitting down with a pen and a piece of paper or an Excel spreadsheet if you're great with Excel, and writing out these goals to guide you as you start looking at properties. In our 12-month training program we do, one of the first things you're going to do or learn on that is your property goals and your personal goals, and evaluate your financial commitments and what you need to get out of them, things like that. So it's literally right at the top for us. It's the most prioritized element when you're starting out looking for deals. Next stage is, once you've worked out all your goals, your risk tolerance, your time horizon, you've worked that all out, you're now going to analyze numbers. So you're going to be looking for gross yield, net yield, return on investment, that sort of thing. Once you've set your goals, the next step is to dive straight into your numbers. That's the only way you're going to be able to do this. So when it comes to assessing any deal, understanding the key metrics like gross yield, net yield, and return on investment is essential. So let's start with gross yield. This is your rental income divided by the property purchase. Multiply by 100 and it will give you a percentage figure. So let me give you an example. If a property costs 200,000 and generates 10,000 in annual rent, as in yearly it earns £10,000 in rent, your gross yield would be 5%. It's a quick way to gauge if a property will provide you the level of returns that you're targeting. But do keep in mind that gross yield doesn't account for expenses. So gross yield is actually a top line figure. But once you take out all of the property expenses like insurance, things like that, that 5% might be more like 2%, and it doesn't look as appealing. Next, you've got net yield. So net yield, this is where it gets more accurate and is considered, this is where it gets more accurate because it considers your expenses for the property. This is things like maintenance, management, and other ongoing costs like insurance and stuff. So to calculate it, take your annual rental income, subtract all of the expenses from that, and then divide by the purchase price. Now, if you're working with a property management company, for instance, their fees will affect your net yield. So be sure to include all of those costs. And then return on investment, or ROI, as you'll hear it. It's one of the most crucial figures for all investors. So it's calculated by dividing the annual profit by your initial investment. So let's say you've invested £50,000 into a property. This is covering the deposit, renovation costs, and it'll earn £5,000 in profit each year. So your ROI would be 10%. Now, the higher your ROI, the better your return relative to your investment. 10% is normally a good figure. Obviously, the higher it is, the better. But I would say 10% is an average figure. And I also want to mention about cash flow. So I haven't spoken about this yet, but cash flow is simply the monthly or annual income that's there after you've deducted all your expenses. Positive cash flow is essential for investors looking for a steady income stream. So if you're getting in this to be able to drain your bank account, basically, of all the money because you want to have the fancy car and the big house before you put the work in, and you put your business into a negative cash flow situation, when problems arise, such as maintenance or difficult tenants, or, you didn't spot something wrong with the roof when you've done a purchase, it was going to cost more than you thought it would do. If you don't manage your cash flow, all of a sudden you'll be in a situation where financially you aren't able to pay for all of these things. And that is a really, really bad spot for an investor to be in. To make these calculations easier, there are several online calculators and resources. In our training program, we have a how-to guide, and it has like 20 or 30 how-to videos or how-to write-ups on exactly how you calculate all of this stuff, capital appreciation and all of the other stuff, mortgage payments, everything like that, because it's important. You have to understand it. And it has to be accessible quickly to you. Once you start doing it on a day-to-day basis, it becomes kind of second-hand knowledge, and it's normal. You deal with it every day. But when you're first starting out, all of these ROIs and net yield and gross yield and cash flow can be really daunting. So once you've got to grips with your figures, or analysing your figures, you need to examine the property location and market trends. So location, as you know, I mention it all the time, is everything in property investing. But beyond general desirability, there are specific factors to consider when assessing the property location. Local market conditions is the first one. Are property values in that area stable? Are they increasing, or have you seen a decline in them recently? Websites like Rightmove and Zoopla, they provide recent sales data for free, which can give you an idea of the market trajectory over the last 2 years or 18 months. Here's an example. So in areas like Birmingham and Manchester, we have seen like a steady growth over the past few years. And this is driven by sort of the regeneration work that's being done in those areas, and also by strong rental demand. So bigger companies are moving into the area, which means more employment, and so on and so on. Next, you need to look at rental demand and tenant profile. Ask yourself, is there a strong demand for rentals? Look for areas with high employment rates, universities, hospitals, big employers, those sorts of areas. You're looking for good transport links, whether it be train, bus, whatever it might be. These are typically good indicators of high tenant demand. So if I give you an example, properties near train stations in commuter towns often have higher rental demand due to their easy access to large cities. So I used to come from an area called, or near, High Wycombe. We were 40 minutes outside of London. The rental demand there is astronomical. We still have property there, and I can tell you now the price for a 2-bedroom flat sits at about £1,400 a month. No garden, no balcony, just a flat. It's madness, but that's because it's smack bang on the M4 corridor, the M25, the M40. It goes on the main Chiltern Line railway, which is 45 minutes or 40 minutes on the fast train into central London, into Marylebone. So it has all of these really unique selling points for people who want to work in, high employment areas. Amenities and infrastructure is another one. So schools, parks, shopping centres, public transport options. They can all make a property much more appealing for a tenant. So try visiting your area yourself. If you don't know it, definitely visit. If you know it, just become more familiar with it. Explore it at different times of the day. When's it busy? When's it quiet? Is there certain times or certain aspects at night in the particular area you wouldn't want to go to because you feel unsafe? Look at all avenues. You need to see how busy it is. Check out kind of local amenities and gauge the general atmosphere. That's what I do. Gauge the general atmosphere. If you're going somewhere and it's just not a place you want to be because it's a back street, side alley kind of feeling and you're uncomfortable, although you will find tenants to live there, in reality, it'll be harder to put a tenant in and also to command top dollar for that tenant. So consider that when you're looking at property. And then finally, there's any future development. So any planned development like shopping centres, increased transport links, or increased residential areas, these can increase the location's appeal, but also, more importantly, the property's value. So the local council's planning department or website, like Planning Finder, provide information on up-and-coming developments that might impact your investment. And you're looking for it to impact your investment positively rather than negatively. So if you get in and buy at the right time, you'll find that your investment can go up as much as 100% in some places, depending on where you are. Let me give you an example, okay? So a friend of mine invested in Liverpool when the city announced plans for a new business district. This is a while back now. Now, property values in that area increased as obviously the development progressed, and tenant demand soared through the roof. So knowing all of these factors in advance, this friend was able to go out and purchase at the right time in the right place and subsequently benefit from the increased rental and value, capital appreciation in the property over a period of the 5 years, which is brilliant, absolutely brilliant. In fact, they managed to remortgage and come out with exactly the same money they put in, come out with it all and some to be able to buy a second one. I'm not going to go into detail on here, but let me tell you, it was very successful because they brought at the right time. So once you've done that, you're going to then look like you're going to be looking to inspect property condition, and you're looking for any potential red flags. So let's talk about the property itself. So you've done all your figures, you found out the area you want to be in, you found a property, the deal looks great on paper, but it can fall apart if the property has major issues. So it's crucial to evaluate the physical condition carefully. This is where a lot of people go wrong. So first of all, you're going to be looking for structural issues. Now, if you don't have these qualifications, employ someone who does. So always check for signs of structural problems. This will be like cracks in walls, roof issues, dampness, anything like that. These can lead to really costly repairs down the road, or sometimes even at the start up front, because you can't rent it because you weren't aware that the roof had a severe leak. So you're going to have to repair that before you can allow a tenant to move in. Hiring a surveyor, as I said, for a professional inspection can save you from making huge costly mistakes. So remember, paying for a survey up front is much cheaper than dealing with those hidden issues that you might find later. You're then going to be looking at the cost of any renovation works or refurbishment work that you're going to carry on, or carry out, should I say. Even just the slightest cosmetic changes, like a fresh coat of paint or a new carpet, they all add up. So look at what those costs will be. Factor in these costs in your overall budget when you're assessing the deal's viability. I've seen investors underestimate renovation costs quite considerably, and it led them in a position where they basically overspent their budget by half. Imagine going over your budget halfway, an extra 50%, and then finding out that it's no longer viable as a financial option, or that you can't remortgage because you've overspent and there's a ceiling limit of the value of that property. And then I would be looking at compliance and regulations. So make sure the property complies with local regulations. This will include things like your electrical safety standards, energy performance requirements, gas requirements. So in the UK, properties must meet specific standards for rentals. So you have to verify that everything is up to code. And it can be very onerous on the landlord, if I'm completely honest. But actually, a lot of these are safety checks. So why wouldn't you want your tenant to be safe in your property? Why wouldn't you want that? So to me, I've never understood why people shout and scream about it. If you've budgeted correctly, if you have brought properly, if you had analysed your figures properly and not overexposed yourself, you should be in a position where compliance and regulation are standard parts of your rental portfolio. And finally, I mentioned red flags. So look out for red flags. Anything like subsidence, mold. Mold's a big one. Poor plumbing, drainage issues, because these issues can basically scare your tenants off, and they often lead to higher maintenance costs. So check the property's history as well. Like websites like Land Registry will let you know if it's been up for sale, what the sale prices were. And if this property has been sold on every 2 years, it could highlight that there has been some potential issues, and you want to ask why the property is being sold on. So just keep that in mind. It may not have any issues. It might just be that people add an extension and move on, and then add another extension and move on, or whatever it may be. But it's important that you look for those red flags. Don't overlook them if you find them. The thing that I have seen, actually, I saw it recently as well. The things that I see regularly, and unfortunately I've seen it recently because somebody came to one of our training programs, and mentioned this to us when they joined. I'm not going to mention names. They found a property, it was priced well below market value, and they saw it as a bargain. They were like, oh my God, this is amazing. It's a bargain. And they did a quick scout round. They had a basic survey, didn't have a structural survey or anything like that. They didn't dig deeper for any red flags for the building. And they ended up buying it thinking it was a bargain. And it's turned out to be a huge money pit. I mean, a massive money pit. And they have had to plough every inch of their pennies, their savings into this to be able to bring it up to rental standards, which means they don't have any more money to be able to invest. And it was a harsh learning curve. So please, whatever you're doing, make sure you look for red flags. If a property is well below market value, I guarantee you there will be a reason. And finally, I want you to make sure the property deals align with your long-term goals and your investment strategy. So a good deal is about more than just yields or low purchase prices. It's about fitting the property into your larger investment picture. So you'll have portfolio diversification, for instance. So if you already have several properties, think about how this new property will add to or diversify your portfolio. If all your properties are in one area or one type, i.e., student rentals or single family lets, consider adding a different type of investment to reduce the risk. Exit strategies are the second most important thing. So every good investment should have a clear exit strategy. Do you plan to sell it in 5-10 years, hold for rental income, or perhaps pass it on? Understand your exit options. It helps you determine if the deal truly fits your goals. Then you're going to be looking at income versus growth balance. If you're aiming for early retirement through cash flow, prioritizing properties with strong rental yields is pretty essential. If you're more focused on building wealth for the future and leaving it as generational wealth for maybe your children, you're looking for areas with high potential growth. Even if the current yields are a little bit lower, you may be looking for capital appreciation more. Stress test deals. So lastly, run scenarios to see how the deal holds up if market conditions change. So for example, if a property price falls by 10%, what would happen? Or if interest rates rise, what would happen? Stress testing helps you understand how resilient the deal is under different circumstances. So for instance, let's say you're considering a flat in central Manchester, an area known for strong growth. You might accept a lower rental yield today because you believe the property values will rise significantly over the next decade. This way, your expectations and long-term goals are aligned with the deal itself. So thank you very much for joining me on today's episode of the Female Property Expert podcast. I hope you feel more confident about assessing property deals. Remember, a successful investment starts with a thorough evaluation process. So take the time to analyse the numbers, inspect the property, and ensure it aligns with your investment goals. If you found this episode helpful, please subscribe, leave a review, and share it with others who might benefit. I'd love to hear how you're applying these strategies in your property journey. So feel free to reach out to us on social media. And also you can come via our website if you're interested in learning about any training programs we have. But until next time, happy investing. And remember, every great property deal starts with a solid evaluation. So make each deal count.